Oh, there are so many yummy vegetarian options out there. You could try like lentil soup, veggie burgers, tofu stir fry. The possibilities are endless. Welcome to The Explainer. Today, we're going to tackle a topic that I know can feel a little dry, but trust me, it's absolutely crucial for every single business out there: classifying your expenses. Getting this right is the key to saving yourself a ton of time, a massive headache, and yeah, some serious money when tax season rolls around. You know the scene, right? It's that time of year and you've got that shoebox. You know the one. It's just overflowing with faded receipts. You're frantically digging through emails, trying to find that one invoice from last March. It's a special kind of chaos, and it brings a lot of stress, mostly because you're second-guessing everything. Can I claim this? What about that? That fear of making a mistake is very, very real. But what if I told you we could swap all that chaos for total clarity? Today, that's exactly what we're going to do. We are going to build a simple, mental, financial filing cabinet together. It's only got 5 drawers. And by the end of this, I promise you, you'll know exactly where every single business expense belongs. No more guesswork. All right, so here's our game plan. We're going to open each of these drawers one by one. We'll start with your everyday costs, then look at the big investments, tackle those expenses with special rules, and finally, cover what you absolutely cannot claim. Then we'll put it all together. So let's get started. Let's pull open that first drawer of our filing cabinet. Now, this one's probably the biggest and the one you'll be using most often. It's where you'll file all the everyday costs of just keeping the lights on and the business running. We're talking about your current expenses. So, what exactly does current mean in this context? Well, it's pretty simple. These are the costs that get used up or consumed pretty much right away in the process of you making money. Think of them as the fuel your business is constantly burning through. You know, if you run a coffee shop, it's the coffee beans, the milk, the paper cups. You buy them, you use them to make a latte, you sell the latte. Boom. The benefit is used up right then and there. And these costs are all the essentials you deal with day in and day out. We're talking office supplies, and that's not just pens and sticky notes anymore. It's your monthly subscription to Microsoft 365 or your accounting software. It's the wages you pay your team and the payroll taxes that go with them. It's the rent for your office space. And of course, it's those utility bills that show up like clockwork: internet, electricity, heat. These are the absolute fundamentals. Now, here is why this first drawer is so incredibly important. These expenses are almost always 100% deductible against your income in the very same year you paid for them. This directly lowers the amount of profit you pay tax on. So let's say you earned $100,000, but you had $60,000 in these current expenses. Well, you're only going to be taxed on $40,000 of profit. It is the most powerful and immediate tax benefit your business has. Okay, drawer number 1 is sorted. Let's slide that one closed and move on to the second drawer. This one feels a bit heavier, a little more substantial. This drawer is for the big stuff, not the everyday things you use up, but the long-term investments that are really going to build your business's future. This is the drawer for capital expenditures. The magic words that separate this drawer from the first one are right here: a useful life of more than 1 year. See, unlike those coffee beans that were gone by Tuesday, these are the assets that are going to help you make money today, next year, and for many years after that. They become the backbone of your entire operation. So what kind of things go in here? We're talking about the major league purchases. It's the new delivery van for your catering business. It's the building you bought for your warehouse. For a freelance photographer, it's that pro-level camera and lens kit that's going to be your workhorse for the next 5 years. Or for a software company, it's the powerful servers that run your entire platform. These aren't just expenses. These are true assets. And here's the perfect, simple way to lock this concept in your mind. The ream of paper you feed into the printer? That's a current expense. You'll use it up this month. But the printer itself, well, that's an asset you're probably going to use for the next 3, 4, maybe 5 years. That makes it a capital expenditure. See the difference? One is consumed, the other is invested. So here's the catch. Because these assets last for years, you can't just write off the entire cost in year 1. It wouldn't really be an accurate picture of your business. So instead, the tax system lets you deduct a portion of the cost each year, which reflects its gradual wear and tear, or its decline in value. This whole process is called claiming capital cost allowance. You'll hear it called CCA. Basically, it spreads that tax benefit out over the asset's useful life, which makes a lot of sense when you think about it. Okay, we're making good progress. Now we're getting to a couple of special drawers in our cabinet. These require just a little more attention to detail because they have some special rules attached. Let's get into prepaid and restricted costs. First up, let's open drawer number 3, prepaid costs. All right, imagine this. It's December and you're feeling really organized, so you pay for your business liability insurance for the entire next year. You've paid the cash right now in this tax year, but the benefit, that insurance coverage, is for the next tax year. For tax purposes, what really matters is matching the expense to the period you get the benefit. So in this case, you'd only deduct 1/12 of that cost in the current year, for December, and the other 11/12 get deducted next year. It's all about when you get the value, not just when you cut the check. Okay, on to drawer number 4, restricted expenses. Now, this is where it gets really interesting. The items in this drawer are 100% legitimate business costs. There's no question about that. The catch is, for different policy reasons, the tax rules only let you deduct a portion of what you actually spent. Let's look at some of the most common ones. Taking a client out for lunch to discuss a project is a totally valid expense, but you can generally only deduct 50% of that bill. The government's logic is that there's a personal benefit element there too. I mean, you had to eat lunch anyway, so they basically split it with you. Going to industry conventions is fantastic for networking, but you're limited to deducting the cost for only 2 per year. And for your home office, all those deductions, like for utilities and rent, they can't be more than the net income your business actually earns. In other words, you can't use your home office to create a business loss. And that brings us to our 5th and final drawer. This one is maybe the most important one to understand perfectly, because filing something in here by mistake is what can lead to some serious problems. This is the drawer for non-allowable expenses. The items that belong in this drawer are completely black and white. These are things that no matter how much you feel they helped your business, the government has made a clear policy decision that they are not deductible. Period. There's no gray area to navigate here. It's a hard no. So what's on this do not claim list? Well, for starters, any government fines or penalties. Got a parking ticket while making a business delivery? You can't deduct that. The government's not going to subsidize you for breaking the law. Golf club memberships are another big one. Doesn't matter how many deals you close on the 9th green, the membership fee itself is not deductible. And then, the biggest one of all, personal expenses. This right here is the brightest, clearest line in all of tax law. You cannot deduct your personal groceries, a family vacation, or the new suit you bought, even if you only wear it to client meetings. The cost of just driving from your home to your office every day, that's a personal commute. Mixing your personal and business expenses is one of the biggest red flags for auditors, so keeping that separation crystal clear is absolutely non-negotiable. Okay, we did it. We've looked inside all 5 drawers. We've talked about the everyday costs, the big investments, the tricky special rules, and the definite no-goes. So now, let's just step back and take a look at the beautifully organized financial filing cabinet we've just built. How do we actually use this system? It all boils down to this incredibly simple flowchart. The next time you're holding a receipt, just ask yourself these questions in this order. Step 1, is this a day-to-day cost that gets used up quickly? If yes, it goes in drawer 1, current. If no, move to step 2. Will this thing last for more than a year? If yes, drawer 2, capital. If no, ask, did I pay for this in advance for a future benefit? That's drawer 3. And if not, does it have a special limit on it, like 50% for meals? That's drawer 4. And finally, if it's none of the above, you have to ask, is this thing on the do not claim list? If it's a personal expense or a fine, it goes straight into drawer 5, non-allowable. That's it. That is the entire system. You now have the complete framework to turn that mountain of receipts into a perfectly organized system. You have the power to look at your business finances not with stress, but with clarity and confidence. So the only question I have left for you is this. What's the very first expense you're going to pick up and file away, knowing with 100% certainty exactly where it belongs?